We're going to talk about right now about a book here that I am, I don't have it with me. Normally I hold the book up and I go through all the pages, but it's Profit First. It's a book by Mike Michalowicz, wrote Profit First. If you haven't read it, it's almost a mandatory reading for my clients. So here are my notes open. The Parkinson's Law. Parkinson's Law says that you will spend as much time or get as much done on a project as you allot the time to it. So if I have to get a lot done on a project and I allow myself so much time, well, that's going to affect how much I get done on the project. The time is going to limit the production, and you're going to get as much done as you have time allotted. What Mike did was he turned it around to money. And what he says is you will only have as much money in your checking account as you allow. So if you only have one bank account, okay, and it's called, your business account, and the money comes in this way and it goes out the same door. All right. Remember those diners with the two doors that flopped? It's really the same opening. Someone comes in one side, but it goes out the other way, but it's the same opening. If you allow your revenue to sit in the same account as your expenses, that's the Parkinson's law effect. It's going to happen. And you're going to always be draining your expenses as quickly as your revenue comes in. And as your revenue doesn't come in, your expenses are going to slow down. Hopefully, as your revenue comes up, your expenses will go up. So Mike says, we want to put profit first. What is the number one reason that we're in business? A business is in business to make money. Okay. So let's make money. Let's guarantee we make the money. And let's go ahead and open up a secondary savings account called Profit First. Okay. Now, what I'm going to do is I'm going to show you guys some Excel stuff. Now, I know not everyone's excited about Excel, but I worked on this today and I think it's pretty cool. I think it's pretty sexy, if I do say so myself. So let's just say we're going to come up with a fictional company. Okay. And we're going to say that in 1 year, we're going to bill $100,000. We're going to make it a nice round number, $100,000. So what you want to do is you want to create these profit centers underneath, or these savings account. So one thing that you definitely want to do is pay yourself, and let's just start small. Okay. These numbers and these names are all theoretical and they're all made up by me. You can make up your own accounts for your own projects and your own priorities. So I'm going to say at least I need to start off, because I've been in business for 3 years and I've never made a dime. All my money's been reinvested into my business. All my money that comes in goes right back out to expenses or assets or insurance or taxes. Okay. I bet it has. So if you create this account and you want to save 5% and you want to walk away at the end of the year with 5% profit, you're not going to go to Maui on 5% of 100,000, but you are going to be in the black, and it's a baby step, and it's numbers. It's your Excel sheet. Anyone who wants this Excel sheet, by the way, put it in, chat something, text me, email me, Jeremy Torsk at atlanticbusiness.com, and I'll give you this Excel spreadsheet. So it's all tied together to that one number up top and these 5 numbers here, or these 6 numbers. So next thing you want to say is, what's really important is I pay my taxes. More companies go broke because they don't pay their taxes. They take all their money and they bring it into the company, and then they pay out their expenses. And God forbid, even worse and more stupid, is they're paying themselves a salary or taking a draw without paying for their taxes. Then the year ends and they just say, well, wait to the accountant. I got a really great accountant. He'll make all the expenses and the overhead count and deductibles and deductions, and I won't owe that much. And then I'll just pay it out of my next year's income. Well, here, I'm going to give you a big X for that one. X, that's not the way to do it. That's the perfect way to go bankrupt. Trust me. So make one for your taxes. Your taxes are probably going to be 25%. All right, 25%. But you are going to have deductions, and owning a business is a great way to save money and make money and not pay. There's a lot of legal ways to not pay every single dime of the tax bill that you think you owe, because there are deductions because you're investing in the company, and there's lots of great legal deductions that you could take. So let's just say you take 15% because you're struggling at only making $100,000, and you'll take a chance on that. I'm good with that. At least that's a great honest start, okay? So I plugged in 15%. Now I know that my insurance bill, let's say we know it costs $3,000. Well, $3,000 is 3% of 100,000. So plug in 3% of your insurance because here's what a lot of companies don't know, okay? They don't know because they don't look. When they call the insurance place, right? And I'm sorry, Mitch, for giving the secret away, but I don't think you make the money on it. Maybe you do. Let's say you get a quote for general liability and auto and your contents and the building insurance and all this, and let's say it's $3,000 for the year. Well, you say, okay, great. How about we do, $300 down and $300 a month, and then the double payment last month, whatever, however, it comes out to $3,000. Um, well, most likely that's about, I don't know, 12, 13, 14% finance charges that are going to be tacked onto this. That 3,000 becomes, 3,300, 3,200. And you're going to be paying a lot of finance charges if you pay it monthly or quarterly or semi-quarterly or bi-yearly. There's finance charges that you're paying that you probably don't even realize. Look at that closely next time on your policy. Instead, this year, take 3% of every check, and I'm going to show you how we do it, and put it away. So that way, when your renewal comes up, you can stroke a check right to the insurance carrier and pay the retail price, the full price with no finance charges. Okay, so right there, hopefully you save some money right there. The next one is loans. Let's say you have a couple loans coming due, and they are not due yet, but you got a couple years grace with this small business um, bureau giving out all these loans over the last few years, and I think in this July, I think payments are coming due. Well, you better start taking some money out for that. So I put a 5% for loan. Again, you can call this your Aunt Millie. I don't care what this line item is. It could be anything that you want to save money for. I called it loans just to prove a point. And the last one is assets. Things are always going to break. You always want to invest in the company. Well, I got 3% plugged in here. So I got 31% total on the profit, tax, insurance, loans, and assets. That leaves 69% or $69,000 at the end of the year to pay my expenses. So the first thing you got to do is go, well, shoot, do I have $72,000 worth of expenses? And if you do, you got two choices. You got a bunch more choices, really, but I'm gonna boil it down to two. You got to either cut expenses to get it down to 69 so you can save this money, or you can lower some of this stuff. So maybe you don't save for assets this time. Maybe your loan, maybe you go 4%. Maybe your insurance, you go 2.5%. Maybe your profit. Look, you always got to profit. That's your money, but let's start making something. But maybe it's not 5%. Maybe it's 1%, 2%. Okay. Taxes, I would never go under 15 personally. And this is not financial advice, by the way. This is just business 101. And Mike come on, I have such a hard time with his name. Michalowicz. Mike Michalowicz's advice from Profit First. So, how does this look in reality? Okay, so I'm going to show you what happens here. Here is month number one. Okay, month number one comes in, and you bill everybody, all your clients, and by the 10th of the month, most of your invoices are paid. 70% of your invoices are paid of the prior month's billing. What you're going to do is you're going to take whatever's in the account on the 10th of the month, whatever's in that main income account, and you're going to pay yourself first. So populate that account, that profit account, 5%. 5% of 5833 is 291.67. The next thing you're going to do is pay your taxes. So you're going to take 15% of 5833. Then you're going to take 3% of 5833 and put it in for some loan stuff. Take another 3% or 5% for the loans, 291.67, and another 3% for the assets. At the end of the day, you're going to end up taking 31% of your 5833. You're going to move the rest of this money into the expense account, which is a separate account. It's a checking account. These are savings accounts. This is a checking account called expenses. Money comes into this account. You move the money out of here on every 10th and every 25th, and whatever's left, you put in here. and that's going to be 69% of your whatever your revenue is for that on the 10th. Now the 25th comes, and your income has been building again because people have been paying their invoices on the 25th of the month. If the balance of your customers paid within the first 10 days, this is 70%. These numbers are all changeable. As soon as I change it, all the other numbers change. So if you ask for this Excel spreadsheet, I'll walk you through how to use it. But hypothetically, the last 30% of your business came in by the 25th, and you have $2,500 now in your account. You're going to take 5% of your profit of the 2,500. You're going to take 15% for taxes of the 2,500. You're going to take $75, which is 3% for insurance of the 2,500, and so on. So on the 10th, you took 1,800 out. On the 25th, you took 775 out. You move the 2,500, which is not going to be 2,500. It's going to be 1,725 left, and you're going to move it down into expenses. So you're left with zero in your income folder on the 10th, and you're left with zero on the income again on the 25th. So at the end of the month, you had 8,300 come in. You moved out 2,500 at the end of the month in total, and you're left with 5,750 that your expense is now deducting from that account. Okay? Everybody with me? Give me a hallelujah. Month number 2 comes along, and you guys, let's say I'm using fixed numbers here, guys. I don't want to get this too complicated, right? Month number 2 comes along. You're going to do the same thing. On the 10th, you're going to move money down here. On the 25th, you're going to move the money down here. Whatever's left in here on the 10th and 25th moves down to expenses, and that's what the expense paid from, and your income is left at zero. What do you think happens at number 3, month number 3? That's the magic month. Here's where everything changes. Not really. Everything stays the same. You do this every single month. Every 10th, you move your percentages down here. This is what Profit First is about. And on the 25th, you do the same. Now, we're not going to go through this 12 times. This is just what it's going to look like at the end of 1 year. This is actually where the magic does happen. If you didn't touch your savings account, and if throughout the months on the 10th and 25th, you religiously and consistently move that money down into the savings account, you're going to end up with $31,000 between those accounts. You're going to be able to give yourself a disbursement of $5,000. That's a win, right? Hallelujah. I finally made positive income, right? Fireworks, right? Bam. I got the money. I got money. I got $5,000. I got something to show for it. Now, maybe part of that 69,000 is as an expense payroll. Maybe you're already paying yourself, $20,000, and that was part of the expenses. That's fine. That's not changed. This is called profit, though. We want to talk about making profit. And at the end of the year, you can do that disbursement, or you can do whatever you want with it. Hopefully, you had enough money left over in your expenses account. You didn't have to dip into it. And actually, on the other side of that coin, hopefully you had more money in that account that you can then go and take that profit up to 6%, 7%, 8%, right? So let me show you what some of that looks like, okay? So instead of 5%, let's say you were able to work that up to 15%, right? Now we're talking $15,000 of profit, okay? Maybe the assets didn't cover that. It's not a lot of money, $3,000. So you're working up to 6% in your assets, all right? So now you got $6,000. Maybe up here, that $100,000, all right? Let's take that $100,000 and let's move it down here where we can see it and actually do something with it. And let's play with that. And let's just show you some math here, some real general, really fast, down and dirty, easy math. Okay. I didn't think I would lose my spot this far. So let's just keep scrolling over here. Bang, bang, bang. Month 12, right there. That's where we want to be. So instead of $100,000, let's say you've increased your business to $250,000 at a 15% margin for profit. Now you're up to $37,000. See how you can play with this thing all day long. $500,000 company. This works on all size companies as long as you're not making profit and you do your pay yourself first, take these percentages down. You see month over month, it all is doing the same thing. $12,000 after month 2, right? Month 3, $18,000, right? It all keeps adding up. If you want your profit to be at 20% and you're at a $500,000 of income, that's $100,000 profit. And 6% of your assets, $30,000 a year going to assets. And you'll be able to stroke that check for 75,000 come March. Anyway, you see what's going on here. The book is called Profit First. Oh, there it is. Profit First. Gosh, got lost there. Mike Michalowicz, Profit First. That's the overarching idea of the book. I definitely okay, so here's some questions. Thank you, Christy. Let's go back to the accounts. Why can't you combine the accounts that you're allocating for savings or future upgrades to one account to simplify? Because it's Parkinson's law. As soon as you if these are must saves, I have to do taxes. I have to have this insurance paid. I have to pay this loan back. As soon as you co-populate those lines, it's not going to go to those assets. It's not going to go to where they're allocated to. It's about having laser focus on hitting a goal, saving money for profit first, then saving money for paying your taxes, which is paramount to staying in business, having that insurance paid. As soon as you start co-mingling, which is what they call it in the fiduciary responsibility, co-mingling of funds, you lose control. Now, do you want 32 accounts here? No, you don't want 32 accounts, but you could have 32 accounts, but you don't want that. You want to take out anything that's a monthly expense is going to be this expense. If it's not a monthly expense or something you want to pay off at the end of the year, then you want a specific goal to hit on that. And then you can play with these numbers throughout the year. Let's say I'm at 6% and at 30, halfway through the year, I got 15,000 and that's all I need. Well, then you could back that 6% and make it 0 and put more towards your profit or, invest in something else